All right. Hey guys, we are live. Thanks for joining us. This is my radio voice, Rob Tatro here from the Tatro Wealth Advisor Group. I'm testing out my radio voice. Good to have you guys. Thanks for joining us today. I am here today with our Chief Investment Officer and uh, team super guru, Adam Haig. Adam, thank you for joining us.
Yeah, thank you, Rob. Hello, everybody. Happy to be here.
Yeah, you've done a few of these now. You're starting to get the experience in the chair.
Yeah, I
How's
even got a haircut for this one, so
was I chirping your hair last time or no?
I think a little bit. Yeah.
Okay. All right. So let's get into questions now. I'll start with this one. Let me start with this one right here. When do you think the markets will return to normals? All right. So
After.
so the only answer I can give you is an answer you're not going to like, but the answer is definitely at some point, but I don't know when that is. And that's unfortunate that I don't know when it is. We can take a look at history being any indication, and we can take a look at what's happened over the past. Historically, 20% market corrections takes 6 to 15 months, somewhere in that range, to make the new kind of to go through the correction. We are now at a 20% correction, roughly, not quite, on the S&P 500, a little bit more on the Nasdaq. So that is, maybe we should start by putting that into context. That's a pretty significant correction. I believe we've had about 20 of those in the last 100 years in the US. So, or maybe it's 30 of them, something like that. So these happen on a regular basis, but it's more than a 10% correction for sure. 20% they use the term bear market when it's a 20% correction. I have a feeling, Adam, and then I'll segue to your answer. I have a feeling this one is moving a lot faster than most.
Mhm.
What do you think?
Yeah, no, I agree with you. And we were talking about it a little bit before, just how, with the rise in technology and information that everybody gets constantly bombarded with, these cycles tend to happen a little bit quicker. Um, you know, Things are constantly in the news and stirring people's emotions, and particularly with this correction, because it seems to be very politically driven by the tariff announcements and how quickly they get rolled out, and how unexpected some of the announcements have been, particularly with levels and who they've been targeting. But one thing about this is, since it's very politically driven, you know, it is impossible to know when markets will return to normal, but it could happen very quickly, right? Like, it could happen with a single announcement, or even a single tweet. So, I like your answer that it definitely will return to normal, but it is impossible to know when, although this time it could happen, a lot quicker
Man,
than it
just in
has in
my
the
career,
past.
Adam, like I've only been doing this only this 16th year for me doing this, but I think of like when I started, or 17th years, and like the markets would, like it would take a while for stuff to, because what would happen back then is the markets would correct a little bit and there'd be a little bit of selling, but
Mhm.
nobody was getting the news on their phone about what was happening in the market today. Maybe you'd watch the 6 o'clock news and you would see that the markets fell 200 points today, but largely, you'd finish a month minus 3 or 4%, and that was pretty bad.
Mhm.
And then you'd see it on your statement the 15th of the following month, and then we would get some calls. We'd get some calls. We'd be like, "Hey, what's happening? The market was down 4% last month," and we go,
Mhm.
"Yeah, no, it wasn't a good month. Here's what's happened. There was a thing with interest rates or inflation or whatever was happening," and then we would say, "But you know what? It could get worse." And then that would get a little bit more selling. Then we get another down month, maybe 2%, then maybe an even month, and another down month. And it would take like 6, 8, 10 months for this to like actually manifest itself, right? It would take like a while and now like what I noticed in COVID is like, boom, it happened so quick. This was 5 years ago, COVID.
Mhm.
It happened so quick, right? 2 months, a month and a half, boom, you lost 40% or 35% on the S&P,
Mhm.
and the recovery took, what did it take, 4 months or something, six
It
months
was pretty quick. Like,
Yeah,
it was pretty quick.
or less than that, maybe 3 months.
Yeah.
And I'm noticing this is quick. Like last week Thursday was, quote unquote, this announcement, right, on Tariffs Liberation Day or whatever the heck it was
Yeah.
called. So I have a feeling these market cycles are moving quicker than in the past.
Yeah, no, I agree. And I mean, if you take a look at the last couple of big drawdowns, right? If you look at 2008 and COVID in 2020, like, there's always different reasons for the drawdown, but 2008 was more structural, just problems with the banks and stuff. But then you saw 2020, which is a little bit more comparable to this one, I think, because COVID happened and nobody knew there was so much uncertainty going on. Nobody knew what was going to happen, and that led to the correction. But when politicians responded with their various programs and stuff, and people felt a little bit more safe, a little bit more comfortable, there were all sorts of liquidity and support programs. That's when the markets came back, right? And this correction is very politically driven by the uncertainty around the tariffs. And so if we get a resolution to that or any indication that there's progress being made, I think markets could come back quite quickly.
Okay, so there's a lot of questions that are coming in, Adam, so I'm going to start putting them on. I'll show this one right here. Hi, Rob. I'm a big fan of your sister, Tanya. Tanya is my sister. I'm also a big fan of her, by the way. I've seen on social media that now is the time in the market. Now is the time to buy in the markets. Would you agree? So before you answer that question or I answer that question, I would just caution you guys, social media, just be very, very careful. This is what is driving fear in the market. It used to be that you'd get your news in like newspapers, 6 o'clock. And I'm not saying that's better. All I'm saying is it's a lot easier to manipulate the message on social media than it is, in my opinion, in other traditional media forms. So just be very careful what you're reading. Remember, someone's got an angle. Every time you're seeing something on social media, there's an angle, right? Someone's either trying to sell you something, trying to get clicks, trying to monetize their clicks, trying to make money in some form or way or grow or whatever. So there's a reason that they're trying to be bombastic or the crazier they are with their predictions, the more likely they are to get clicks. So would you agree that now is the time to buy in the market? Or do you want me to start answering that question? I'll start and then I'll let you finish. So
sure.
Again, we don't know where the bottom is, but we know that 20% market correction historically is a fantastic entry level point for some of your capital. So if you have money on the sidelines of any kind, or if you have capital that you're sitting on, or if you're sitting on cash, or you're getting some funds, or I don't know, maybe you're a very aggressive investor and you want to leverage, whatever that might be, whatever that number is that you're wanting to put to work overall. So let's say I've got 100 grand that just matured from an investment or something, and I got 100 grand sitting in cash aside from my portfolio. I would probably do a percentage of that, make a plan ahead of time. So maybe it's you put half in the market today at a 20% correction, half of that 100K, let's say, or half of that 10K, or half of that million. The number's not really important. What's important is the percentage and what it relates to in your overall wealth. And then, or just have a plan. The plan, talk it through with your advisor. It's going to depend on your liquidity needs. It's going to depend on, but have a plan for how much you're going to put in today and when are you going to add to that. Maybe it's in a week, or maybe it's in 2 weeks, and then you just leg into the market. That's what I would do, Adam.
Yeah, no, I agree with that plan, and I would say that we don't know when the market will bottom. We there could be further room to go down, but when after a sell-off is generally the best time to buy, and historically, I mean that's played out that way every time, every correction like this over the long term. If you buy when stocks are down, you're going to come out ahead. So you do have to be careful on social media, but yeah, I think now is a good time to buy.
Okay, I'm going to show this comment here. What advice, by the way, keep the comments coming. I will get to them. There's a lot of them. I promise I'll get to them. What advice do you have for those of us who just started retirement? We've saved and planned. Now we see our investments quickly depleting. Time is not essentially on your side. We'll stick to the format. I'll address it first, and then I'll let you talk a little bit. So I would say this. We know, so you just started retirement. So I don't know, you're 60, 65, 70, you're somewhere around that age. We know that historically if you're married or if you have a partner, the odds are that one of you is going to live 50-50, that one of you lives to 90, I believe. So we're talking about a potentially 25-year investment horizon if you're 65, and one of you is likely gonna live till 85 or 90. That's at least a 20-year investment horizon. 20 years is typically 4 market cycles, right? So that is a complete crash, a complete rebuild to new highs, so to say that you don't have time, I would disagree with, and that's my opinion, but it's also kind of what history has indicated. So the reason that you're getting worried in retirement is probably not because, it shouldn't be because of the time. It should be because of the fact that maybe now either you have more time on your hands and you're watching this more than you were before, or maybe now you're drawing down on your investments and you want to make sure you're not selling stocks at a 30% discount. So this hopefully was planned out with your advisor. I'm hoping that your advisor made a plan to keep a portion in either fixed income or alternatives or non-stock exposed investments that you could sell, keep its value, and feed your monthly living needs while you're in retirement. And if that's been done properly, this shouldn't impact your retirement at all, because the markets will recover, whether it's 9 months or 6 months or 3 months or 12 months or 2 years, and you're not going to be dead, hopefully. And I don't think you will be. So
Yeah,
comments on
no,
that, Adam?
I would echo that. I mean, my advice would be to make sure that you have a plan in place and you're comfortable with the plan. And if you're feeling uncomfortable with it, it might be time for a review with an advisor, a financial planner, and just make sure you're comfortable with, what your income level is going to be, what your expenses are going to be, and make sure you have enough to cover that. Make sure that you're in the appropriate asset allocation, and that you're comfortable with how you're invested. Risk tolerance varies from person to person, depending on a whole bunch of different factors. And so, just check in, talk to them, make sure everything's appropriate for what you need to go forward, and make sure you're invested properly.
You shouldn't have to panic sell stocks
No.
just because you're 65 or 66. So I know that on the big picture, let's say you had, I don't know, $1 million in your retirement, in your RSP, your TFSA, your LIRA, all your different accounts. And today, maybe you're a balanced investor and today it's down 10%. So you're at 900. I know that sucks. I know that sucks inside of your heart to see that. And you look at it and you're like, I had $1 million, now I have 900. I would still go back to your plan that you made when you were retired, and the numbers should still work. This shouldn't be like ruin that, because the stocks will make new all-time highs. They always do.
Yeah.
So I'm going to next show this comment here from Carl. Alternatives. You talked about diversifying, Adam. I'll let you start to answer this question here. Do you expect them to shed value or show growth this year? Well, we definitely expect them to grow this
Yeah.
year for sure.
No, I mean, we like alternative assets for environments like this,
This
right?
is why we
Because
own them.
they're, they're insulated from the market volatility that you see in stocks and even in some of the fixed income instruments with, they're driven, the prices are driven by different factors, more fundamental factors, a lot of real estate and infrastructure, those are consistent cash flow generating assets, and the cash flow is going to continue throughout the cycle. So I expect them to continue to grow and to provide a lot of support for portfolios.
If anyone's like fearful, I know fear is driving this market right now. There's a ton of fear out there. But if you're fearful and you're thinking, oh, like I don't know where I could put my money, like I was talking, we talked about this yesterday, you and I, Adam. Like think of how great those alternatives that we own are right now in this freaking out market. Like people are going to pay their rent, the music royalties, the farmland, like the stuff that is completely unexposed to what a president in the US is doing or imposing or whatever. Like how good is it that we own those in the I know the rest of the portfolio is obviously hurting, but it's great that we own those, and I'm glad we manage money the way we do.
Gives me some comfort for sure.
Yeah, so it's a good piece to own. And if they end up doing, I don't know, 8 or 9 or 10% this year, or 11 or 7 or somewhere in that range is, I think, where the alts are going to finish this year. Well, that's sure with almost zero volatility, sure beats the heck out of this roller coaster. And it's crazy that like 6 months ago, we'd get calls from clients 4 months ago being like, hey, like the NASDAQ is up like 25%. Like, why don't I own more of that and less of those stupid alts that are only doing 10%, right? Like, and then we said, there's a reason they're here. Trust me, there will be a correction at some point. It's going to happen. And when it does, you'll be very happy you have a third of your portfolio sitting in this chunk that's generating tax efficient income, low volatility, uncorrelated to traditional markets, generating cash flow, and here we are.
This is
3 months
exactly
later.
What they're for, right? Exactly what they're for. And they're great diversifiers, and they get people through times like this. Yeah.
Okay, so this is a double comment, Diggs, from Madam Cicero. I'm going to show it. Question is, how do we avoid losing our shirts? And then the second part of that, and our minds. We know this is hard, and I'm, I guess, more experienced to this, and I know that I don't want to say I'm a robot when it comes to this, but I'm very much able to compartmentalize my emotions when it comes to the markets, and I've been really good in my career at removing emotion, making a plan, focusing on logic, and taking a look at the big picture. And I know that's not easy if you don't do this every day, and you're looking at your portfolio and you keep thinking that, oh, what if it's not there? What if this time it's what if it's different? What if things, are globally disrupted? And what if, so I'm going to say this, every time I've ever been in a market correction, it's always the same feeling you have in your stomach. It's always the, oh, this kind of sucks. What if it's, you're always like, oh, what? It's a little different this time. And it is, right? COVID was not the same as 2008, was not the same as the tech wreck, was not the same as, driving planes into the World Trade Center, was not the same as interest rate and inflation crisis. Like, those are all different things. And I've told this story before, but I'm going to tell it anyways. In one of the years that I was managing money, there was an Ebola crisis. And I don't know, nobody remembers this because it was such a small blip, but the market fell like, I want to say 8% in like 2 weeks. And I remember talking with my dad and being like, holy smokes, is it different this time? Like, is Ebola going to wipe out like a quarter of the population, and like it's actually going to be different? And I remember thinking about that. And the lesson I learned that day was, no, it's not different. Whether it's interest rate or whatever, it always is different. Naturally, it's different. This isn't the same market correction that we had, but the underlying principles remain the same and haven't changed our investment philosophy. I don't know if you have. So, how
Yeah.
to avoid losing your mind? Maybe I'll let you touch on that.
No, I mean, what you said is true. I mean, people, that's why people say it every time, right? Is this time different, right? And that's why it always, creates some anxiety. And it is a little different. It's different factors, but, we'll get through it. And the underlying principles, I think, are the same, and we'll get through it. So how do we avoid losing our shirts and minds? I think that's part of the value that we offer, right? Is you let us worry about that stuff, and you can watch the media and stuff if you want, and keep up to date with it. But know that we are taking our emotions completely out of the process, and just reacting to the data and the facts on the ground. And we're managing your money responsibly, making sure you're diversified, and yeah, we will help you avoid losing your shirt and your mind.
Awesome. Next question from the Godfather of Soul. Am I right? Is James Taylor is that his name? The Godfather of Soul? Or
I don't know. I thought James Taylor was a folk guy, but
Diggs is laughing. The producer Diego is like, he's a musician. He knows the answer. He's like, you guys are wrong on this. Anyways, probably not the Godfather of Soul or whatever it is. With regards to crashing markets, will Trump refusal to abandon his tariff? How far do you feel the markets will fall? So this is how much further do we have here? How far are we down the pain cave? Is the question. So it's a similar answer. The answer
mhm.
is, again, we don't know, but let's put things into historical perspective. We've seen way worse scenarios historically that have been kind of 40% corrections. I use kind of 40 in my mind in this situation as a maximum. That's what I use. And obviously, there's no real maximum, but I just use that as a barometer. So if there's no progress and no continued good news, and we continue to see negative strategies, I'll call them, or non-proactive strategies by the leader down south, I think you could see a situation where, if we continue to see no, what I think will happen. Maybe we should start with that. What do you think, Adam? Maybe you
Yep.
should start by saying what we think. Maybe I'll let you speak to this. What we think will happen, and then yeah, maybe touch on that.
Yeah, I mean, it's impossible to tell how far things will go, and how far Trump will go with the tariffs, right? But there are, I mean, the U.S. is a democracy, and there are other mechanisms in place if you know people have dug their heels in too much on tariffs, right? The Senate can override Trump, if there was too much pain going on in the U.S. You know, there's other outlets, I should say, maybe, to address it. It's not just Trump, and it has been so far. It feels like it has been so far, but you know, there are some checks and balances that are still in place that I think will kick in. You know, I think a lot of what's going on right now is just the style of negotiations. They're like tit for tat, trying not to lose. But you know, I think this will get resolved. I think it's in the benefit of everybody. You know, there are some issues with the world trading system right now, but you know, I think it is in the best interest of Trump, of the U.S., of China, of all these countries, to get everything resolved. And it's a bit unfortunate the way things are playing out. But you know, even if tariffs remain, I think they'll be at a level that'll allow the U.S. to prosper, and you know, that should put a bottom under stocks.
Just in the last 20 minutes here, Adam, Nasdaq's up 1,000 points. Crazy. Wow. Anyways, I shouldn't. That doesn't matter. To be clear, that doesn't matter. All it means is someone's getting back into this market, right? If you see 1,000 points on the Nasdaq, 1,000 points, that's 7% on the Nasdaq right now. We're flushing out some sellers, right? Obviously, because on every trade, every single trade that happens, there needs to be a buyer and there needs to be a seller. We know who the buyers are, right, Adam? Who are the buyers? It's people like you and me that are sitting on some capital, that are slowly putting that money to work, buying opportune stocks at the right time, some hedge funds, you know, anyone who's got kind of, I'll call it smart money or smart capital on the side is so we know who the buyers are. And now it's flushing out the sellers, which are the people that are freaking out, panicking, losing their minds. So the more sellers get flushed out, the better it is for the bottom. I'm not saying this was the bottom, to be clear, but it's good to see 1,000 points up on the Nasdaq for sure.
It is, and this kind of goes back to what we were talking about before, this being sort of a politically driven sell-off, and because of that, it can turn around really quickly. You'd always have to be careful with what you see in the news, but I just see the headline now that Trump's declared a 90-day pause on the tariffs, and I don't know if that's true, but you know, that's something that would drive the Nasdaq up 1,000 points, and you know, that's how quickly it can turn around, right? And that's why it's so hard to time the market.
Piece of news or something, or it's a false piece of news that doesn't. It is crazy, because if you actually, if you and I talked yesterday, imagine if he pauses these tariffs for 90 days, what do you think we get? And I think we both said something like 6 or 7 or 8% immediately.
Immediately, well,
maybe that's happening already. So again, I'm not saying that was the bottom, but if it was, this is why you need to have a prudent strategy where you're deploying capital and you're investing and you're putting some money to work, because otherwise what happens is this market moves so fast that you miss it, and you miss like a year's worth of returns, right? If you miss one 8% bump, 9% bump, that's your year's worth of returns, right? If you just miss that day or that hour in this case.
It's really important to have a strategy and stick with it, right? Because like just this headline, 1,000 points in about 30 seconds, right? How do you can't time that. You need a strategy.
You can't.
You need a long-term.
By the time you get the information, plan. It's too late. The market's already moved. There's a question here from David McKibben. It's a similar question, and maybe the question should be more which sectors maybe.
Take advantage of the correction.
So the question is, when is the right time to take advantage? We talked about that, to take advantage of the correction. We said have a plan, right? Have a plan, build a plan, make sure you have some assets that are immediately going into the market and some that you're going to leg in. And obviously, like if you got 10 million bucks and you got $50,000 of capital, I'd say put it in, buy stocks today. Don't worry about it. Don't get cute, just buy it. But if you've got 50 grand and you're adding 50 grand to the market, then you want to be a little bit more prudent, right? If it's 50% of your net worth, you want to be a little bit more prudent in how you're going to buy, how you're going to invest into the market. So I think we've covered that piece of the question. Undervalued stocks to get before the correction commences.
The right time, I would say, you know, it's impossible to time the market. So, you know, again, it goes back to having a strategy. You know, if like you said, if you have cash on the sidelines, like when things are beaten down, it is a good time to buy. But, you know, trying to find the bottom like wait for the absolute bottom isn't possible. So I would say if it's fits with your strategy, then now is a good time to buy. If not, then maybe hold off. But yeah, don't be trying to time the market. That's a very, very difficult thing to do.
I'm going to show this comment that came in 17 minutes ago um, from Larry. Trump tariff demands have never happened before. Why not move out of stocks and not catching the knife issue? So I think he's saying it's hard to catch a falling knife. This is one of my dad's greatest lines. It's hard to catch a falling knife, but this catch a falling knife generally applies to, like, in my opinion, applies more to like a penny stock or a when you're buying the market as a whole, you're never going to be able to catch a falling knife, but you're going to get a decent price if you're prudent and you're diligent in your plan and your approach to legging into the market, right? You're not trying to catch a falling knife. You're catching many different knives as they're falling. And some of those will be great, some of them won't be. But if this guy had just moved out of the market at 12:11 when his comment came in, he's down now 8% in 17 minutes. So that's why you don't do it. And obviously, I don't know what'll happen with the rest of the day here. Obviously, we might fall another 1,000 points. It's possible because this is the market. He might come back and say, that's our whole point. Our point is you can't afford to step aside from this market. You can't afford to do it. If you have proper asset allocation, it's way too expensive to be out of the market.
Yeah, I would echo that. It's why not move out of stocks? It's a good question, but you shouldn't just own stocks anyways, right? Stocks are just one of your sources of returns. And it's important to be diversified, not just across stocks, but yeah, in terms of asset allocation as well, right? So make sure you own equities, you own fixed income, you own alts and different kinds of alts. And having that diversification is going to insulate you from having to move in and out of stocks.
James Taylor is clarifying. Folk rock. Thank you for clarifying that for us. You knew it. Okay, I was wrong. I throw stuff out sometimes. Sometimes it hits, sometimes it doesn't.
Is it James Brown? James Brown is the folk.
James Brown. Yeah. I'm wrong. Okay.
Maybe I'm older than you.
No, I think we're the same age. Okay, question here on. I'll show this one. We talked about it a little bit, but I'm sure we can address it again. Because really the only thing that's affecting, so the question is, how do you think these tariffs will affect private mix and private REITs? So private mix mortgage investment corps, they lend money to either individuals or corporations at a slightly higher rate than the banks do. They find kind of great loans and they get a little bit of a premium. If the banks are able to get 4.5 or 5 or 6, these guys are able to get 7 or 8, and that's how you benefit from that. They benefit. So they can't have bankruptcy. So like a significant recession could obviously hurt mix, I think, or a recession or a prolonged recession could hurt mix. But I mean, the ones we use, they went through 2008, 2020 unscathed. So I'm not concerned about it whatsoever. Private REITs, you could argue this is going to be very good for private REITs. You could argue that with a potentially reduced interest rates, like what do you think interest rates, quick sidebar here, they were calling 2 interest rate cuts 2 months ago, now they're calling for 4. What are your thoughts there?
Well, I mean, if the tariffs get paused, that's going to be supportive of the economy, so it might go back to 2. It's again, things change really quickly.
Yeah, it's too quick almost.
But no, I agree with you that private REITs will continue to do well. I don't think the tariffs will have much, if any, impact on them. Mix as well, especially the mix we use, are generally, fairly conservative. The borrowers they're lending to are generally unable to get financing at the bank, not because they're a bad credit risk or anything, but because they're business for self or a newcomer to Canada, and generally like they're low leverage and have a stable income, but they don't fit in that bank model, right? So the goal for the mix is to get them into home ownership, get them through that first couple of years of payments and stuff, and then get them back into the bank. So well, if there is a housing crisis or a recession, that's mix might encounter some difficulty there, but I think especially the ones we use, they should be okay.
Yeah, I think they'll be fine. And I'm very, very optimistic about our alts that we have in our
Yeah.
portfolio. I think it's the next 2, 3 years are going to be fantastic. There's a comment here from Kowalchuk Aldry. He gets a free plug, his real estate rentals. True Social, I didn't verify this, so I'm assuming that you're not just messing with us. Raising from True Social, raising China tariffs to 125% and 90-day pause and substantially lowered reciprocal tariff during this period of 10%, effective immediately. So here's what I think happened there. Uh, Senators, congressmen are going home every night. They're talking to their husbands or wives. They're talking to their donors. They're talking to their voters. And they're going like, oh my God, I think I have to say something. I think I have to do something. And there's enough people that have been in the president's ear, I would imagine, over the last week and just like pump the brakes a little bit here. And I
Hmm.
think this is that announcement. Um, it doesn't mean that this is over. It just means that like stop the bleeding for a little bit is what someone probably told the president. Like just stop the bleeding. Say something to just stop the bleeding for a little bit.
Yeah, I no, I tend to agree, and I mean this is more in line with what Trump campaigned on, right? Is trying to get China to the table to negotiate on trade, and some of the other tariffs I think kind of caught everybody by surprise, right? Because it was basically every country in the world that was on that chart on Liberation Day, and so him walking that back, makes a lot of sense.
Those poor penguins that have to pay the
They got to pay
there's
their
a
share.
question. Yeah, they got to pay their share. It's been a while since I've seen a green number at 9% up. Like we see a lot of red numbers on our screen historically.
Lately.
Usually
Yeah,
you see like the down days are big down days. Why? Because fear drives market. People mass sell, they blast everything.
yeah,
And usually the recovery is like a percent, 2%, a percent, 2%, a percent. We don't see 9% days green that often. This is exactly in line with what we talked about yesterday, Adam. We're like, I wonder what would happen if he just announced a pause, just like to stop the bleeding for a little bit. So this might just be that. It might just be like his advisor telling him, like, dude, your favorability really right now is really, really bad. Like you're not polling great. Like, can we just announce something for now? And that might be just this, right? Like there might still be a lot of quivers in the
yeah.
arrows in
And
the
it
quiver.
just it happens so quick though. I mean, that's why you can't time the market. That's why yeah, it just
Question
is an
from
example of that.
Lucette here. If you're managing someone's investments, are you making the changes, buying on behalf of your client? So this is a great question. Thanks for asking, Lucette. Yes, that's our job, right? So people pay us to be fiduciaries of their wealth. So fiduciary means we have to act in their best interest at all times, and we manage money on a discretionary basis. So we figure out the asset allocation together in a discovery period where someone becomes a client. So you say, oh, here's what I have. Here's, we talk a bit about investments, your history, et cetera. And we come up with an asset allocation together. You might be a 50% stock type client with 20% fixed income and 30% alternatives. That would be a 50, 20, 30. That's your asset allocation. And then we manage your portfolio within those parameters. So we'd be making sure that the asset allocation is kind of plus or minus 5% of that. So that means we could add stocks if the markets have fallen. We're going to rebalance those positions for you. We also exit positions that we don't like and enter positions that we do like on a discretionary basis. But yes, that's what we do. Adam, I don't know if you want to touch on this.
Yeah, no, I don't have much more to add, but yeah, we're always, always looking for good value, and if we see it, that's when we're making changes.
Yeah. Um, Question here from interest rate cuts in Canada. I'll let you handle this one. I think I'm on the
What's I
fence
guess
on
another
this. So the
interest rate
question is, what is
Canada.
your guess on another Canadian interest rate cut here? So the next meeting, Fed meeting is what, in 2 weeks, is it? Or next week?
The Bank of Canada, yeah, it's coming up. It's tough to say. I would expect the cut, but with things changing this quickly, I know the governor takes a long-term view and is more focused on the economy than the stock market. But I mean, things are going to be data dependent, right? And it's really, I do think there's going to be a cut. How about
You
that?
do think there'll be a cut? Yeah.
I do. Yeah.
I was in the cut camp, but I wonder if, would this change things one day?
I don't think so. I mean, especially the market, right? It's really inflation driven, inflation and inflation, unemployment, and GDP, I would say. And,
Yeah, it's really good for, again, I'm going back to our alts. Alts short form for alternative assets. So if you're a client of ours, you probably have 20 to 40% of your portfolio in alternative assets, 20 to 30, let's say. And that third of your portfolio was up annualized 9% in Q1. So we're that's how we manage money, like a pension, right? So when I did my MBA like 20 years ago, I remember studying asset allocation of the largest endowment funds on the planet, pension funds, endowment funds. How did they do? Why are they better at managing money than we are? Why? And I thought, are they better stock pickers? They're not better stock. And I'm going a bit on a tangent here, but I want to mention this. They're not better stock pickers. I want to reference the importance of asset allocation, right? Asset allocation, the most important thing for your wealth, if you're watching this right now, is asset allocation. And the reason that they were outperforming wasn't because they were better at picking stocks, RBC instead of Scotia or Home Depot instead of Walmart. Is because they, first off, they had exposure to a third asset class that most Canadians don't have, alternatives. Most Canadians have stocks and bonds. That's it. If you're at a bank-owned firm, that's what you likely have. And yet, why the best money managers on the planet, they have 30%. Back then they were doing 30, now it's 40, now it's 50% of their portfolio in alternative assets. So I said, what if I just took that approach and brought it to Mr. and Mrs. Everybody? And what we found is not only do you get exposure to these alts, but you also get access to investments that nobody else can get access to because of our purchasing power, because we manage over $1 billion, right? We have access to investments that most can't even touch. So I'm excited about the alts in case you can't tell. And I think they should have a place in pretty much every Canadian's portfolio at
yeah.
some level, a slice. Sorry to go on a tangent there, Adam.
No, I agree with you though. Alts provide keep saying it, but the benefits of diversification, and you don't have to worry about whether the Bank of Canada is going to cut or not.
Or someone decides to impose unilateral 200% tariffs on a country, right?
Yeah, exactly.
Okay, there's a question here about does what you are seeing, this question came in earlier in the chat. So based on the stimulus, what makes you think the current financial situation worse or better than the other stock market drops in the past? So why I think I probably said something like, I think this is not as bad as other ones. I probably said something like that. And what makes you think that? Well, I'll answer briefly and then I'll let Adam touch on this. But I believe it's because um, this is very easily fixable.
Yeah.
Very easily fixable. And we just saw one way that you could fix it. Imagine they just said tomorrow, we negotiated tariffs, or we're putting a pause on tariffs, or you know what? Uh, we won. We won
Yeah.
this tariff thing, and like all the countries are happy now, and we're happy, and people are going to buy American. And like if that whole thing happened, like the economy was chugging along 6 months ago, right? Unemployment all-time low, consumer spending, balance sheets were strong. Like it was not in a position where it was in '08 or 2020, where we thought 10% of the population was going to die,
Mm-hmm.
or 2022 when interest rates and inflation were a serious problem, or 1981 or 1987, or go back further. But that's in my lifetime. I don't equate this with those. That's why I thought that this was likely less of a downside than those crashes.
Yeah, no, I think that too. I think because it was, we talked about it before, because it was politically driven. It's in everyone's interest to get a deal done, and Trump's a deal maker. He likes making deals, and his style of negotiation, caused some uncertainty in the markets. But because it is a solvable problem, and you know they know the solutions and they're working on making a deal. That's why I think it's not a structural thing that is going to take time to work through. We don't need to create a TARP, a troubled asset relief program, and get mortgages into that, because it's a negotiation. I think that makes me think it's going to be less bad than the past.
Okay, I'm going to show you another comment here from Cal. Do you think Trump just made this correction happen a bit earlier than it would have happened anyway? I think what he's getting at is, I think the last time we spoke or 2 times ago, I said, you know what, valuations are a little frothy, and I probably said something like that. And my dad calls them healthy corrections, when you see like a 10% move based on no real news, just like, okay, enough valuations here. Let's pull the meter back, and that's. I think the question is, would that have happened anyways? Would it have happened anyways? And I think the answer is maybe.
Yeah, I mean, it's impossible to know, right, what the counterfactual is. But and I think maybe, it exasperated it. It might have been a catalyst for a little bit of a correction and driven things a little farther than they would have been. The market's done really well over the last couple of years. And so, a correction, this is, wouldn't be the end of the world. So, it is impossible to know, but it could have happened anyway.
I'm going to go through a few slides here real briefly, and then I will. Come on, I can do this every time. It's a big stress for me to just figure this out. Share screen, present. And I'm going to talk a bit about some of the stuff that I prepared. We prepared a tiny bit of things here. Producer Diggs got me. Awesome. Thank you for your help there, Diggsy. So just a couple things. Biggest 2-day declines. So last Thursday, Friday was the 5th worst 2-day decline, followed, 87, 20, 2008. These are all the worst 2-day declines. This chart in very pixelated format, it would almost be Minecraft-esque, this chart. My son would love that. I took my kids to see Minecraft this weekend at the Winkler Theater, by the way. Great place to watch a movie. The forward S&P 500 returns. What does the market look like 1 year out, 3 year out, 5 years out, after having big market meltdowns? Big market meltdowns like we've just seen. Well, we're showing you a chart for a reason. It's positive. It's positive 1 year out, 3 years out, and 5 years out. So I wanted to just put that into perspective. Again, we don't know what'll happen, but it's good to be reminded of these things. Next piece. Do you have a comment on this one, Adam?
Just everything's green, right? There isn't even one red figure in there, right? So, it just goes to show that, things do come back. Every time feels different, but, it's not.
This one, I don't really know what we want to show with this, other than there are bad years, there are good years, I guess. I'll go to the next one here. This is the VIX. Do you want to explain very briefly what the volatility index, the fear gauge, as we call it,
Yeah,
what it is and why it matters?
Yeah, the VIX is a gauge of how much the market's moving, up or down at any given time. And generally it's higher when there's down periods because, sell-offs are much sharper than gradual increases usually. So, you can see on there that right now where we are, it's quite low on this chart, but 45 is a very high level for the VIX. But it shows that after sell-offs, very similar to the last chart, after sell-offs, things always tend to come back, and it is sort of indicative of a good run for the stock market.
I just got a notification on my phone. I don't know about you, but it just says markets soar after Trump tariff pause. So everyone who gets these notifications on their phones, these kind of, this is the Canadian press. I don't know. I don't get that many notifications on my phone, but that one pushes through. So that means like my kids, my wife, my mother-in-law, my dad, everyone's getting these notifications on their phone. So like it's so real time now, and it wasn't like this in the past. The VIX touched 60, I believe, on Monday, didn't it? 55 or 60?
I think that sounds right. Yeah.
Yeah. So we're in the 50s for sure. We were at 52 this morning. So the only thing we want to show is
it's down to 37 right now.
Yeah.
Actually,
Well,
with the increase.
Now it's like,
Yeah.
okay, I have less fear. I have less fear because these tariffs are out, right, for 90 days. But before those tariffs, they were it's measured by looking at the price of the different options, and it's like a real measure of how fearful people are of the market, and it's measured in dollars, not like a survey, right? So it's real. It's a real indicator. So when the VIX is this high, it means the fear index is this high. It's an absolute no-brainer. If ever you get this VIX index, you just buy the market. Here's why. Maybe you're not at the down spot. Maybe you're not at the worst, but a year out, 2 years out, 3 years out, 4 years out, 5 years out, the numbers look pretty green. Well, they're very, very green. So
yeah,
The VIX, and then the opposite is also true. If ever you see the VIX in the like 6, 7, 8 range, you might be due for a little bit of a bumpy time here, a bit of a correction. So pause on that. Did you have anything to add there, Adam? Otherwise, I'll go to this
No,
next
just
chart.
looking at the ticker on the bottom, it shows we're kind of, going through that again.
Yeah,
Bounce off
volatility,
the lows. Yeah.
volatility. Economic policy, uncertainty index. You wanted to share this chart.
I did. I mean, and it was just, it's a highlight, what we've been talking about through the whole, what do we call this? A show? I was going to call it a podcast, but it's not a podcast. But that this sell-off, it's driven by uncertainty, right? It's driven by political uncertainty about what's going to happen with the tariffs. And that's why we've been saying that it's a very solvable issue that we expect to get solved. And hopefully announcements like this continue and there's more and more deals. It's not just a pause, it's a permanent fix. But once we get this policy uncertainty out of the way, I think things will go a lot smoother.
Crazy that we have more uncertainty about policy, almost more than during COVID.
COVID, yeah.
It's crazy. COVID was, yeah, COVID was
Nobody
a
knew what was
mental
going to
time.
happen. Yeah, I mean that's
Yeah. A couple more charts here, and then I'll get
uncertainty.
back to the comics. Okay, so this one, all same chart, but showing China and Europe. Obviously, uncertainty over there.
Yeah.
And then the last chart, P to E ratios. Obviously, the P to E ratios have fallen a little bit. P to E is price to earnings. In other words, how much is the stock trading at for every dollar of earnings? So if a stock is trading at $20 for a dollar of earnings, that's at 20 times PE. Stocks were a little bit on the high end here, and now they're obviously probably below historical norms, but we just want to share this with you guys.
It's a good indication of value, right? Because earnings, we haven't gone through an earnings cycle after these tariffs were announced, but there has been talk of them, and earnings have generally held up well so far. So, a low multiple means it's a good time to buy.
I'm going to share a couple comments here. So thank you guys for sharing your comments. We're approaching the end of our hour here. VIX high, we buy. Honestly, like if you could just do that, but here's why you're not going to do it, Benjamin. It is hard. It is so hard to pull the trigger on buying if you're not like immersed in this every day. Like we do it, obviously. I had one of my real estate deals mature, and I've been plowing that money into the market. And I talked to my dad this morning, and he was like, I'll imitate my dad here if that's okay. Hey, I'm strategizing right now to put some capital to work. So VIX high we buy, but it is hard to do. It's absolutely very hard to do because why is the VIX high? The VIX is high because people are panicking. So like everyone's freaking out, and for you to be like, you know what? I see right through this. I'm gonna buy. It's tough to do. A couple more comments here. Rick, be cautious with banks as they earn commissions for recommending certain investment products like bonds in Canada. They push and push. Go to an advisor like Tatro. Oh, look at this. Positive reviews and backing. Oh, thank you, Rick. I don't even know who that is, but I appreciate the obviously our belief. We are independent. We're completely independent. We're agnostic to product. We don't sell product. People pay us for our advice and for us to execute the trades in their portfolio. We don't sell product here. Canaccord doesn't have product. So Canaccord's our back office, and they help us out with trading and all that. So I'm going to show one more comment. That one's funny. This is a funny comment. I have to show this one. I think Rob paid Trump off to pause the tariffs so to increase the markets during the middle of his webinar. Yes, I have that power. I'm so able. I do have a client, first name Brent, who if he's watching, he used to always say whenever we would meet, the markets would rally, and he'd be like, "You're bribing the market somehow to make it." And I was like, "No, Brent, I don't have that power." But thank you for that. What is this? Great content. Thank you guys. And a 90 days hallelujah. I think I got every comment there, almost every comment I think we went through. Do you have any final thoughts, Adam, for our group here, or our show, our podcast, whatever you want to call it?
Um, no, not really. I think we covered everything. I'm glad, it was good timing that this announcement came on during the webinar. But yeah, just stick to your strategy. Focus on asset allocation and diversification. And yeah, call Rob if you want a meeting.
That's the quickest we've ever been proven right. Like, it's crazy. Like, open the show, it's time to be buying. This is time to put some money to work. 10 minutes later,
Yeah.
market's up 9. Again, it might drop 9 tomorrow or the day after, but that's not the point that we're trying to make. Regardless, 20% correction, it's a good time to be putting some of that capital to work.
Yeah.
I remember in 2023, if you guys are bored, you have nothing to do. Sorry, in 2020, on March 23rd, 2020, I did my first ever client live. I did it from the office here. There was no one here because our entire office was working from home. I came in and I did a YouTube live I didn't know what I was doing. I had phones, I had iPads, and I went live at like 2:30 p.m. I think, or 2 p.m., 2:30 p.m. And this was like the absolute day of the bottom. And I'll never forget this because during that day, I called it. I said something like, "This is a generational opportunity for you to be buying stocks. The S&P is minus 38% or whatever it was. This is a generational opportunity. I know it's hard, guys." I said this, and then towards the end of the live, I was like, "I'm just looking at the TV here, and markets have rallied a ton here in the last half hour." And that was the turning
That was
point
the bottom.
happened during my live. And then the next day we were up like 2,000 points, and then another 2,000, and it rolled from there. And I remember thinking like how quickly I was proven. Like, I didn't know at the time, but looking back on it now, I was like shaking in my boots, right? Because like the markets are down like a million and COVID, and it's just like, but I was like, guys, put the money to work. Trust me, like, put the money to work. My job here is to be giving you the advice. Anyways, this isn't the same, clearly, because we weren't down 40, but it is nice to be proven right short term this
Yeah.
quickly. So we'll stop it there for today, guys. If you're on, so what we're telling clients, quick summary, we're telling clients your plan. You have a plan in place. The plan has an asset allocation in place. We will trade the asset allocation. We're going to do that for you. If you have capital sitting on the side, let us know. We're going to make a plan to put that capital to work. If you have, if you're fearful and you're not sleep and you're not able to, if you're losing sleep about this and it's impacting your health, tell us. You need to tell us. That means obviously we're not able to we have to adjust the asset allocation perhaps. And finally, if you're out there watching, you're not a client, go to speaktorob.com if you'd like to book a no obligation consultation to chat with me or someone from my team. Heck, Adam, maybe even superstar Adam could have a chat with you. We're there for you guys, and this is how we grow our business. So thank you guys for tuning in. I know it sucks. I know these are hard days, but remember, if you have a plan in place, you're going to be all right, guys. You will be all right. Short-term pain for long-term gain. We love you guys. Thanks for tuning in. We value you guys as clients. We appreciate there's a lot of things you can do with your time than to come and listen to two guys agree about everything for an hour. So we're thankful that you took the time today, guys. Thanks, and have a great day.
Bye.